Hello everybody, and welcome to another episode of ZEP Learning. My name's Zane, the broker and owner of ZEP Finance, and I'm here today to talk to you about cross-securitisation, or in simpler terms, using more than one of your properties as security for a loan. Now, unfortunately, what I do in a lot of my work is actually untying properties for clients, so separating securities and separating the loans. The reason that I do this, and the reason that it's better in your benefit, is that banks automatically will tie your securities together when you're going for another loan. Unfortunately, the bank staff are trained by the bank, and they're trained to benefit the bank. When you have two properties or more securing the one loan, it makes it harder for you to ever go to another lender. It makes it difficult if you're going to sell that property to actually tell how much of a loan you have at the end. You may need reassessment, and it's not in your best interest. So some of the points why it's not in your best interest, and I'll give some examples. So number one, if you sell one of the securities that is attached to this little loan down here, you're selling this security, getting rid of it, you need to get this property over here valued and make sure that you've got enough equity to cover the actual loan there. The bank actually controls the sale funds that you get, so they can make you pay down that loan if you didn't want to. They can also not accept the loan, so you can actually have to fully reapply for the loan. I have had that happen to a few clients where they weren't aware they sold a property and they actually had to fully reapply for all their loans, and they weren't in the same position as when they got them. It did make it very stressful for them. Another reason why that happens, or why we don't do this, is if we're looking to grow a portfolio or get some equity out to do something, when we're using two properties as security for one loan, the equity that you've got is based on the value of both of those properties. If we have loans secured individually by one property, property A hasn't gone up in value, there's not a lot of equity, that doesn't matter. We have property B that we can then use, and if there's equity there, we can draw it out of that property. So basically it's allowing you to have access to extra equity. Another thing is that if we're paying mortgage insurance, instead of just having one property, the mortgage insurance based on the value of that loan, it can be based on the value of both those loans, and a premium can go up quite a lot. Mortgage insurance premiums are based on the percentage that you're borrowing, so 80%, 85%, 90% of the property values, but also the maximum loan amount. So it does go up in tiers, so 150,000, 300,000, 500,000, 750,000. The premiums actually get quite a lot higher. So if you were in mortgage insurance and you were cross-securitising, your mortgage insurance premium can be quite a bit more than it would have been. Now there's just a couple of reasons of why we shouldn't secure our properties together or cross-securitise. There is a couple of reasons why you might, in a very short-term way. For instance, if you're buying another property and you're using bridging of some sort and you're about to sell a property, that might be a reason why you would. At ZEP, we try never to cross our clients' securities. And as I mentioned before, a lot of the work that we do is actually untying many securities and giving the clients the freedom to do what they want to do and control their own finances. If you'd like to learn more about this, I'd love to have a chat to you and just see what we can do to help you out. As I've always said before, we have many other videos, fact sheets and learning tools on our website, www.zepfinance.com.au, and there's a little Learn tab at the top on the toolbar, and that has everything in there. I'd love to hear from you. If you want to give me a call or an email, all my details are on the website. I hope to hear from you again shortly. Thank you very much.